Hey everyone, welcome back to Corporate Decoder, the place where we decode the wild world of business filings, and let me tell you, this report reveals a rather potent concoction. Get ready because we are diving into a company trying to shrink its way to success by performing a financial magic trick. It is a classic move in the corporate playbook, and we're going to break down exactly what it means for you, the investor. Before we spill the beans, if you love getting the real story behind corporate reports without the jargon, make sure you are subscribed. And if you want to chat about these insights and more with fellow sharp-minded folks, hop over to our Discord server. The link is in the description below. So what we have here is a filing from EQUATOR Beverage Company. Now, the main event in this report is all about a significant change in their stock structure. Think of it like a company deciding to chop its shares in half, but with some important consequences. The big news is that the board of directors decided to do what is called a reverse stock split. In super simple terms, they are taking every 2 shares of stock that you own and turning them into just 1 share. So if you had 100 shares, now you'll have 50. They are calling this A1 for -2 split. And as part of this move, they are also cutting the total number of shares they are allowed to have. They are taking it down from 20 million shares to 10 million shares. This means they're cutting both the existing shares and the potential future shares in half. Why would a company do this? Well, the main reason they give is to try and boost the price of their stock. Companies often do this when their stock price has fallen very low. A low stock price can make a company look less attractive to big investors, like those at large investment funds or pension plans. They might think that if the price is too low, the company isn't doing so well. By doing a reverse split, they can make the per share price look higher and hopefully attract more interest. They say that having a lot of shares out there and a low price has made investors, especially the big institutional ones, shy away. So the hope is that by lowering the number of shares and raising the price, per share, more investors will see the stock as a more serious contender, even though the actual value of your investment hasn't changed overnight. This change became official on the 27th of October 2025. For a little while, the stock will trade under a temporary symbol, which is MOJOD. Don't worry, this is just a temporary measure. After about 20 trading days, it will go back to its regular symbol, Missouri Joe. So your shares automatically got converted. 1 old share for every 2 old shares held becomes 1 new share. It just happens behind the scenes. Now, here is something important. If this split resulted in you having half a share, they are rounding that up to a full share. So you won't get any cash for that half, but you'll own a complete share instead. This is a bit generous, as many companies might pay you out cash for fractional shares, or even round them down. Rounding up helps ensure no small investor is disadvantaged. This whole operation was made legal by filing a specific document called a Certificate of Amendment with the state of Delaware on the 20th of October 2025. This is the official paperwork that makes it all happen. Before this change, the company was allowed to issue 20 million shares, and about 18.17 million of those were actually out there being traded. Now, after the split and the reduction in authorized shares, they are allowed to issue 10 million shares, and they expect to have around 9.08 million shares actively trading. This is roughly half of what they had before, so the number of shares is indeed significantly reduced. And here is the actual paperwork, Exhibit 3.1, the Certificate of Amendment dated the 20th of October 2025, confirming the changes. Signing off on this report is Glenn Simpson, who holds the titles of Chairman and CEO. The date of this report is the 24th of October 2025. Now, let's put on our analytical hats and really decode what this means for EQUATOR Beverage Company. The core idea behind a reverse stock split is often to improve a company's stock price so it can meet listing requirements for major stock exchanges or attract institutional investors. Sometimes a company might be struggling with a very low stock price, and if it falls too low, it can get kicked off the exchange it is listed on. This reverse split is a way to combat that. However, it is crucial to understand that a reverse stock split doesn't magically make a company more valuable. If the underlying business doesn't improve, the stock price might just keep falling after the split, potentially negating the intended effect. It is like rearranging the deck chairs on the Titanic. The company is trying to make itself look better on paper, but the real question is whether the business itself is healthy. The fact that they are also reducing the authorized shares is a significant move. This suggests they don't anticipate needing to issue many new shares in the near future, or they want to make it harder to do so. It could be a sign of confidence in their current share structure or a way to signal to the market that they are not planning aggressive expansion, requiring new stock issuance. The primary purpose, increasing the per share market price, is a double-edged sword. While it might attract some institutional interest, It also means that each share now represents a larger chunk of ownership in the company. For small investors, it might be harder to buy shares if the price jumps significantly, and it could also increase volatility. Looking at the numbers, the reduction from 18.17 million shares outstanding to about 9.08 million is a massive change. This means each share of EQUATOR Beverage now theoretically represents twice as much of the company as it did before the split. The hope here is that the market will see a stock price that is maybe twice as high, and that this higher price will be perceived more favorably. It is important to remember that the total market capitalization, which is the total value of all the company's shares, hasn't changed because of this split alone. If you owned $100 worth of stock before, you still own $100 worth of stock after, just in fewer shares. The real test will be whether this move leads to actual business growth and improved financial results. Without that, the reverse split is just a cosmetic fix. So, what is our take on this? EQUATOR Beverage Company is clearly trying to present a more attractive image to investors. The reduction in share count and the increase in per share price are designed to signal stability and potential. However, this is a strategy that often works best when coupled with genuine operational improvements and growth. If the underlying business isn't strong, this move might just be buying time. The risk here is that investors see through the maneuver and the stock price fails to appreciate, or worse, continues to decline. The opportunity lies in whether this perceived improvement in stock price can indeed unlock new investment and fuel future growth. Alright, that is our breakdown of EQUATOR Beverage Company's latest filing. What is your take on these stock split maneuvers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.